But thank you for the intro, Matt. Let's rock and roll. So Jedi Options, bear put spread. Let me set the table on this because details matter. And I think sometimes you learn a general concept and you're like, yeah, I'm not exactly sure how I apply that in different situations. So I'm going to be very specific in the situation here and the motivation behind why someone could consider a bear put spread. Trying to make this timely and relevant to what the market looks like right now. Okay. So premise number one, okay, I have a bullish portfolio. Okay. Why would you have a bullish portfolio? Oh, I don't know. The market's gone up 16% in the last 6 weeks. I mean, it's not as if being bearish for the last 6 weeks has worked. So if you're following the daily trend of the S&P, you of necessity, you've got to be bullish, right? So that's number one, right? Let's assume you have a bullish portfolio. Okay. Let's also assume that that market is at a critical juncture here where you have a battle between weekly bears and daily bulls. We outlined that earlier in the show today. Okay. And number three, I'm a chess player. Okay. A good trader should be someone who thinks multiple moves ahead and who maps out, okay, if the market does this, then I'm going to do that. If the market does this, then I'm going to do that. I can map out a bullish resolution to this current battle we have. But you know what? I don't like that doesn't concern me because I'm already positioned to profit from that. Okay. I'm already like benefiting from that. So I'm telling you that if I've been riding the daily trend up and still have the bullish exposure, I'm not concerned with us resolving this slowing momentum battle here higher. Great, good. I'll make money off of that. My concern is if we do follow the bearish script from back in August, where the market goes lower, okay, and the daily trend reverses. That's the part that's going to hurt me, and thus that's the one I'm more concerned with as as a trader who wants to not lose money. So the idea here, okay, is that S&P 390 support is significant. Okay, if we break that, I need to reduce risk. I got to get smaller. You reduce risk in one of two ways. Okay, I got two choices here. Choice number one, I'll say A, I could close old bull trades. Okay, listen, I don't have to go bearish. I could just take some bull stuff off the table. I don't know if I have 7 bull trades, maybe I'd close half of those. And I get smaller by virtue of exiting positions, right? Or maybe I'm like, I really like my bull positions. I don't want to close these. So I could open new bear trades. Right. And it's ironic, but by adding new positions, I'm subtracting risk because of the type of position I'm adding a bear trade. So my premise here, the motivation behind the bear put is I'm going to assume that you want to explore this second option. What kind of bear trade could I open to reduce the risk of my bullish portfolio if JPL throws cold water on this rally, or maybe for some other reason the market breaks support and goes lower? Okay, well, you got lots of bear trades you could add. You could buy puts. You could sell calls. You could use any number of spreads. The reason why I think a bear put spread, reason why I think this is an obvious solution is because they're low cost and they have high potential reward. And if a good hedge is potent, okay, it's effective at accomplishing what you need to accomplish. And so if I say, listen, if the market rolls over here, I got a lot of bull trades that I'm going to get punched in the face on. If I'm going to hedge that, I need a bear position that will really like make a lot of money if the market rolls over and can be very effective at hedging a bunch of bull positions, okay? So I don't need some mamby-pamby like out of the money bear call spread that makes me a very small amount of profit. That's fine for a normal trade, but it's not fine for this purpose, which is I need to hedge the portfolio. I need something that can double, triple, quadruple my money that I put in so that I have a big enough profit to offset what I get back in the bulls. Okay. So that's the motivation. Now, when I say that it's low cost and high reward, what I'm talking about like is I might buy a $5 wide spread for $2. And so my risk is 2 and my reward is 3, right? Or I might buy a $5 wide spread for $1 and I'm risking $1 to make $4, right? Where if the market falls apart, like I'm really going to make a lot of money, it's going to pack a good punch. And the corollary to that is if I'm wrong, I'm also not putting out a ton of money such that if the market breaks support and then says JK and goes right back up, I kind of like, oh crap, well, I just bought 300 puts and I'm going to get killed if you don't go down. It's a small capital outlay. And so I'm not too bent out of shape if it turns out to be unnecessary, right? Because the support break didn't come to fruition. So another point, what stock do you do this on? I think it's unnecessary and it's overly complex to be like, well, I'm going to pick some random stock to do this on. Why? Just do it on an index. And so for me, I could use SPY, okay, but I'm partial to IWM right now for 2 reasons. Number one, IWM tends to move a little more than the S&P, and I think if the market rolls over post any Fed nonsense, I think small caps will get hit harder. So if I can do a bear trade on an index that's going to fall further, it's going to be more beneficial to me, right? So I'm kind of partial to IWM for that reason. I also like the chart for a bear more than the S&P. You're seeing more weakness in IWM, right? So my thought here, IWM's at 181. My thought is to like go buy a 180 put and go sell maybe a 175. Because 175 is kind of the next stop. It's the next support level. If IWM breaks this pivot, it doesn't have any support really until 175. So you got a nice window of opportunity there. And I just need to buy enough time for it to get to 175, which December options only have like 2 weeks left. So I'm going to January at this point. I'm going to buy a 180, 175 bear put spread. I suspect I'm going to pay around $2. And I'll make $300 if we get down to 175. So the way I build the trade, come in here again, there's December 2 weeks out, too close. We'll jump to January. I buy the 180. Again, $600 if you want to buy a put. That's pretty expensive. I'm going to make it a lot cheaper by selling the 175 against it. $5 spread. Look, cheaper than $2. Paying $1.85, even better, to make $3.15. I like them. Again, I like the asymmetry risk and a little to make a lot. That to me, wrapping up here, that to me is a well-structured type of hedge. The only lingering question is when do you pull the trigger, right? And what's tricky for me is that the S&P hasn't really shown the bear signal yet, right? To me, what would be ideal is this corresponds with the S&P breaking 390 support. Then I have the evidence that that daily trend is turning, and I feel a little more confident pulling the trigger on the bear put spread. I don't think it's ready yet. I wouldn't pull the trigger here if it were me. So I'm kind of loosely correlating my trigger on IWM to what the S&P is doing, which makes it a little bit more complicated. But I think that's probably the best way to do it.